Kim is the principal at the moment, correct me if I'm wrong, Kim, of SteadyOptions, which, as far as I can tell, is one of the widely praised, widely used companies doing option trading. And I guess you've been trading, Kim, since for many years. Is that right?
Yeah, I basically started. I started actively investing in stocks and bonds in 2002, and then gradually I switched to options. I mean, I still invest in stocks, in ETFs, and bonds, but right now my trading account is mostly focused on options, and I became a full-time trader since 2011. So basically, when I just started trading options, I started with directional strategies, like buying straight calls and puts. And then I realized that I'm not very good with direction, and it was way too risky for me, way too stressful. So I started looking at non-directional trading. And non-directional trading, as probably many know, is when you buy a strategy and you basically don't bet on direction. You can make money no matter if the stock goes up or down, as long as you use basically the correct strategy. So non-directional trading, it can be straddles, it can be strangles, it can be calendars, iron condors, butterflies, stuff like this. And my first strategy, which is basically today the main strategy that we're using, is the long straddle. A long straddle was described in a book by Jeff Hogan called Volatility Edge in Options Trading. So this book basically describes how to trade volatility, more or less. So the idea, for example, if I'm starting to describe a straddle, so straddle basically involves buying both put and call option with same strike price and same expiration for the same underlying asset. And so long straddle is when you buy both put and call, and short strangle is when you sell them. So I'm basically focusing on buying straddle, not selling a straddle. And the reason is selling a straddle can also be profitable, but it's a completely different animal. It's more risky. It requires much higher margin. So I want to focus today on buying a straddle. So when you buy a straddle, basically the main idea is that you don't mind and you don't care what direction the stock moves as long as it moves. So you buy put option, you buy call option, you have to do it in one transaction, and then you just want the stock to move. So straddle is basically a vega positive and gamma positive strategy, which means that it benefits from stock movement or implied volatility increase. Now, what is the issue with regular straddle? If you buy a regular straddle, like not related to earnings, it's okay if the stock moves. If the stock moves, let's say it moves up, your call makes money, your put loses money, but most of the time, if the stock moves enough, the call will make more money than the put loses. So the gain from the call will offset any loss from the put, and the straddle will make money. Now, where the issue is? The issue is that what happens if the stock doesn't move? So because the straddle is theta negative, every day that the stock doesn't move, the straddle loses money. Now, how much it loses? It depends on the theta. It depends how close your expiration is. If the expiration is close, then the loss can accelerate very quickly. If you go, let's say, 3-6 months with expiration, then the loss is a little bit slower. But in any case, if the stock doesn't move, you lose money. So we don't just buy any straddle. We buy straddle on the stocks that announce earnings. So let's say earnings on specific stock is 2 weeks from now. So we will buy a straddle that expires after earnings. And the reason for it is that earnings will keep implied volatility increasing, and the straddle should keep its value over time. However, we will always sell before earnings, because after earnings, what happens if a stock doesn't move, increased volatility will collapse, and the straddle will be a big loser. So if a stock does move after earnings, then you can make pretty good money. But if a stock doesn't move, then increased volatility just collapses and it will be a big loser. So we will always sell our straddles before earnings to avoid implied volatility collapse. Now, what happens over the time of the straddle? So basically, how the straddle can make money? The straddle can make money from stock movement, or from implied volatility increase, or from both. Now, we have basically 3 scenarios. If you can scroll to end of the article, where straddles can be a cheap black swan insurance. So basically 3 scenarios that can exist during the life of a straddle. Scenario number 1, IV increase is not enough to offset the negative theta, and the stock doesn't move. This is basically the worst case scenario. However, IV increase still exists. It's just not enough to offset the negative theta. So usually, unless the IV increase is really not enough to offset the theta, in my experience, usually you can see loss maybe in 7 to 10% range, sometimes a little bit more, sometimes a little bit less. But this is pretty much worst case scenario. Now, scenario number 2 is IV increase does offset the negative theta, but the stock doesn't move. In this case, depending on the size of the IV increase, the gains are likely to be in the 5 to 20% range. In some cases, it will be break even. In some cases, it will be a little bit more. But usually, it will be a winner. Sometimes a small winner, sometimes a little bit larger, but it will usually be a winner. Now, scenario number 3, implied volatility goes up, and also the stock does move. Now, this is where the strategy really shines. It could bring few very significant winners. In fact, we've had winners in range of 50%, 60%, sometimes more. Now, this is not very common because, you have to be really lucky for this to happen. Sometimes it does happen, but this is not typical scenario. So typical scenario is gains. Typical scenario is probably scenario number 2, where NV increase, it does offset the negative theta. Sometimes the stock moves a little bit, sometimes the stock moves a little bit more, but typical gains are around 5, 10, 15%. And we set the profit target for those straddles usually around 10%. And 10% might not sound like a lot for options trading, But remember that the holding period for those straddles average about 5 to 10 days, sometimes even a little bit less. So to make 10% in 5 to 10 days, usually it's not bad. Now, what is the biggest risk when buying a long straddle? So, as I mentioned, the biggest risk is that the volatility doesn't increase. Sometimes it could even decrease, and the stock doesn't move. So the negative theta will basically cause the trade to be a loser. Sometimes it can be a big loser. And this is one of the reasons, basically the main reason, that we don't hold those straddles beyond the earnings announcement, because implied volatility would cause it to be a big loser. So this is basically the summary of a straddle trade, which is how we use it. We use it basically to trade earnings. Sometimes we would also use a strangle. And strangle is basically a variation of straddle when you buy puts and calls not on the same strike, but a little bit out of money. So if let's say the stock is trading around $100, for example, straddle would be buying 100 strike put and 100 strike call. And strangle would be buying, for example, 95 strike put and 105 strike call. So when would we use strangle instead of straddle? For example, when the stock is between strikes, then we would use a strangle. Why? Because we usually like to start delta neutral as possible. So if, for example, there are strikes of, let's say, 30 and 35, and the stock is trading around 32.5. So in this case, we cannot buy 32.5 straddle because there is not 32.5 strike. So in this case, we would buy a strangle, we would buy 30 put and 35 call, and this way we start delta neutral, and then we see how it goes. If the stock moves, we might adjust to stay delta neutral. If it doesn't move, again, we see if we reach a profit target before expiration, before earnings announcement, when we sell it for whatever profit we have. If there is still time, we might re-enter with new strike, for example. And this is basically how we trade it. Now, the main difference between
Kim, should we be looking at your slides? Where should we be looking here?
So I'm pretty much finished with straddle. So strangle is basically describes how we trade strangles. So an example of SPY, for example, if a SPY price is the 414, then we could buy 405 put and 420 call. So
we're in the correct place. That's good.
Sorry?
We're at the correct place in the slide, sir?
Yes. So this is an example basically of a SPY, but SPY is just an example to give to demonstrate how strangle is different from straddle. We usually don't trade SPY options, but some people might, and some people might buy SPY options, for example, before an important upcoming Federal Reserve meeting, for example. So they bet that the stock, like SPY, which basically represents the whole market, they bet that the SPY might move after Federal Reserve meeting if there are some kind of surprise in the announcement. And here you can see the payoff diagram for this position, for the strangle. So the main difference between strangle and straddle is that the strangle is basically slightly more risky trade, depends on the strikes, because the break-even points are usually farther away from the stock. So you need the stock to move a little bit more for the strangle to be profitable compared to straddle. But on the other hand, if the stock does move enough, then the strangle will probably also make more money than straddle in percentage terms. But again, this is just an example for SPY, because again, you have to be right about the direction of the move, and you have to be right about the timing also. Because if you're right about direction and the stock moves, but it doesn't move fast enough, again, the negative theta will start bleeding and the trade will be a loser. But when you trade specific stocks and not SPY, and you trade them before earnings announcement, this is much less likely to happen, because the market will keep some floor under the straddle price because of earnings. Because the idea is that earnings are usually market moving event for this specific stock. So the market makers basically bet that the stock will move based on previous cycles. This is the general idea. Now, it doesn't always happen, but the straddle prices are usually remain elevated before the earnings announcement.
Can I ask you a follow-up question?
Yes, of course.
Would you say that I haven't heard, are long strangles used much outside the context of earnings announcements? Or would you say that that's one of the few cases where they make sense?
No, strangle you can use for earnings as well. And one example, as I mentioned, is when there are, for example, not enough strikes, and if a stock is trading near a price that there is no strike at this price, then if you want to start delta neutral, it makes sense to do a strangle and not a straddle. So I'm not sure if I understood your question correctly, but this is the cases where it makes sense to use the strangle and not straddle for the same case of trading earnings. Okay, but thanks. Otherwise, they are very similar idea. They are both vega positive, they are both gamma positive, they are both theta negative. So the general idea is very similar. And the only difference is one, if there are not enough strikes for straddle, then you would use a strangle. And second, if you want to be a little bit more aggressive, let's say you're pretty sure that the stock or the ETF will move, then it makes more sense to use a strangle, because strangle will probably make more money percentage-wise if you are right and the stock will move. So I would say that strangle compared to straddle is the higher reward, higher risk. So if the stock doesn't move, strangle will likely be a bigger loser than a straddle. But at the same time, if the stock does move, or if you have pretty strong implied volatility increase, then strangle will be a bigger winner compared to straddle. So again, it's a matter of how aggressive or how conservative you want to be. And if you want to be really aggressive, then you will go with strikes that are further out of money. So if, for example, to take an example of a SPY that is trading at 414, you can go as far as maybe 450 call and maybe 370 put. So really out of money, but this would be really aggressive. You really need to the stock to move in order to make money. So high reward, high risk. So any more questions regarding straddles and strangles?
Let's see, does it?
Okay, shall I go to calendars?
Just if anyone does have a question, please put it in the chat and we'll get Don to ask Kim.
Okay, so
Okay. Okay.
Yeah.
Who was it? Who was had what's oh.
Can you use straddles in a situation where you have narrowing Bollinger Bands? Does that work? In other words, where you have a
What?
squeeze and it's going to pop out.
So again, which situation you described?
Saying you have a is that right?
Bollinger Bands. And so it's just basing and it's going to do a pop out like John Carter's.
There's some other kind of breakout.
That's correct.
And it's become very. Does that make sense, or does it only make sense in the earnings situation?
So straddles can be used in many situations. At SteadyOptions, 90% of our trades are related to earnings. Now, it doesn't mean that straddles or strangles cannot be used in other situations. Basically, any time that you feel that the stock is going to make a big move, straddle or strangle makes sense. Now, the only caveat is that, let's say you think that the stock is on the move and you want to use a straddle, be aware that those situations, you are not the only one who sees it. Everyone is basically seeing it. So when people believe that the stock is going to make a big move, implied volatility is going to increase significantly. So let's say you use a straddle, you might be right in direction, but after the move is done, the increased volatility might actually fall. So even if you were right and the stock did move a lot, you still might lose money because of increased volatility, because of implied volatility that basically collapsed. So for straddle to work, you have two things to work for you. First of all, the stock has to move. And second, increased volatility has to be at least stable or increase. If implied volatility decreases significantly, then the options will lose money. So the straddle will lose money as well, unless there was a really huge move. So again, generally speaking, it does make sense, but you have to pay really close attention to implied volatility. And you have to see how current implied volatility is compared to historical implied volatility. So there are tools that allow you to see what's the implied volatility, let's say, a month ago or 2 months ago, whatever, and how does it compare to the current implied volatility. And if you see that current implied volatility is really high, then straddle is probably much more risky, because if implied volatility is really high, there is a good chance that at some point it will come down. And if it comes down, then even the stock moves, it might not necessarily help you. Okay, I see a question in the chat. When you buy a long straddle and it doesn't go your way, do you take max loss on it? Take it till expiry. Or do you use a stop loss, get out early for a smaller loss? So first of all, we never ever hold our options till expiration, like never. Now, in case of earnings, it's even more important. We always, as I mentioned, we always sell before the earnings are out. So let's say we buy a straddle today. Today is Monday. Let's say a company reports earnings on Thursday after the market close, which is in 3 days. So we would buy a straddle that expires on Friday, but we will most definitely sell it on Thursday before the market close. Because again, we don't want to take a chance that we hold it after earnings expiration, then the stock doesn't move, which can always happen. And then what happened, you are basically holding till expiration, till the last day, and implied volatility collapses, and then you can definitely can be near max loss. Now, we will never let it happen. Now, if my memory is correct, the max loss that we had on straddle, like ever, was around 30 or 35%. And even this is very rare. Why it's rare? Because implied volatility tends to hold pretty well before earnings. Now, it doesn't mean that it still always offset the negative theta, but there still will be always implied volatility increase. And even if a straddle loses its value, it's usually typical loss on straddles is between 10 and 15%. Again, I believe the maximum loss was maybe 30 to 35%. When you choose trade strangle and when you choose trade straddle. So most of the time we trade straddle because it's a little bit more conservative approach. The only case when we choose a strangle is, as I mentioned, it's a matter of strikes. So if the stock is trading between strikes, let's say it's a low-cost strike, low-cost stock like maybe $7.5 stock, okay? And there is not 7.5 strike. There is only 7 strike and 8 strike. So you cannot do 7.5 straddle. And if you do 7 straddle, then you basically start delta positive. And if you do 8 straddle with stock trading at 7.5, then you start delta negative. So typically we prefer to start delta neutral as possible. So in this case, we will do strangle with a 7 strike put and 8 strike call. So we basically begin as delta neutral as possible. But this is pretty much the only case when we will do strangle. But something important to mention is that when we do a trade, our members basically not necessarily do the same trade. So many members, when they basically learn the strategies and understand what we're doing, they can do something similar. They don't necessarily do exactly the same trade. So, for example, if we do a strangle because the stock is between strikes, but someone believes that, let's say, a stock is going to go up from now. So maybe they can begin not completely delta neutral, but maybe a little bit delta positive. In which case, if the stock is at 7.5, they will do maybe 7 straddle. In this case, if the stock continues up, it will make more money because you started basically delta positive. So our members many times do variations of the trades that we do. And if we do a straddle and someone maybe believes that, strongly believes that the stock is going to move, maybe they will go a little bit more aggressive and do a strangle instead. So they might make basically more money than our official trade. So do you have any stats on how these long straddles, how they work for you over the past 5 years? So average return of our straddles over, I don't have statistics over the 5 years, but it's basically between 5 and 7% average return over, and it's pretty stable. It's pretty stable, pretty consistent. Now, when I say between 5 and 7% return, that includes losers as well. So the winning ratio is typically between 65 and 70%. Typical winner might be maybe between 10 and 50% and 15%. Typical loser maybe between 5 and 10%. So on average return is between 5 and 7%. And again, since the holding period is so short, it's typically between 5 and 10 days, and we're doing on average between 150 and 200 trades per year, then those 5-7% returns, they add up to pretty significant returns. Now, nothing wrong to do short straddle and strangle under specific circumstances. And again, it's good. I'm always saying that no strategy will work all the time. So it's always good to combine few strategies. If you do only long straddle, then there will be periods of decreasing implied volatility, and those long straddles will be mostly losers. The opposite is true as well. If you sell straddles and strangles, there might be periods of decreasing implied volatility, and those short straddles and strangles will make money. Now, just let's remember that selling straddles and strangles is typically much more risky strategy, because if, let's say, for example, if you sell a straddle before earnings and you hold it through earnings, and stock moves like a big move much beyond what it moved in previous cycles, then your short straddle will be a big loser. So I consider short straddles and short strangles much more risky strategy. It doesn't mean you shouldn't do it, but just remember that usually it involves more risk. Okay, when you enter into strangle position, do you enter at market price or wait till the chart moves to your price? Same question on exiting. So I assume market price, you mean the price of the strangle, not the price of the stock. So first of all, we never do market prices, never do market orders. We always do limit orders. And the reason is simple. When you do market order, especially with stocks and options where spreads are wide, you're losing a lot of money. Because let's say the bid on the straddle is, let's say, $6, and the ask is $7, which is okay. It's a little bit extreme, but for the benefit of the discussion. And if you enter at market price, then you will be filled at $7. However, if you do a limit order and you start, let's say, from the mid, which is 6.5. So you might not be filled at 6.5, but when you wait a few minutes and you increase it gradually, you increase it 6.51, 6.52, you increase it few cents till you are filled. And typically, if I'm not filled within 2 to 3 cents from the mid, I give up. Because that means that the spreads are too wide and market makers are not willing to do business. So I know if I have trouble to enter, I will have trouble to exit as well. So we're trying to limit ourselves to stocks that are relatively very liquid. Now, sometimes we can give up a little bit of liquidity, because if we limit ourselves only to stocks like Apple or Google or Amazon or Tesla, then we will be trading maybe only 15 or 20 stocks. But we want to do more trades. So we do trades on stocks that are maybe slightly less liquid than stocks like Apple or Amazon, but still have decent liquidity. Now, regarding the exit, we usually simply put good till cancel with order, GTC, and just wait it for to fill. Usually we put for straddles, we set our orders around 10 to 15%, and we wait. Now, if it's filled, good. We might re-enter, we might move to next stock. If it doesn't fill, then we basically wait till the last day till earnings, and then we will exit for whatever price we can get. And typically, we wouldn't even wait till the last minute if earnings are announced, for example, on Thursday at market close. Then we would typically exit on Thursday noon the latest, maybe 11, maybe 12. We usually don't wait till the last moment, because at the last hour or two, especially before a big event, the spreads might become too wide and it might be more difficult to exit. But this is the general philosophy of this strategy. More questions before we move to calendars? Okay, so straddle and strangle is basically, this is how SteadyOptions started. We traded mostly straddles and strangles. We did it, I believe, for our first maybe 2 or 3 years. But our strategies evolved a lot over the years. And basically, one thing that it's important to understand, that no strategy will work all the time. So straddles might work for a period of time, and then maybe there a period of a few months, then it doesn't work that well. Maybe the period of time when overall the market is more calm, that doesn't move enough. Maybe implied volatility goes a little bit down. So because straddles and strangles require the stock to move to make money, so you have to hold in your portfolio strategies that would complement straddles and strangles. And one of those strategies is calendar spread. Now, calendar spread, basically what it does, it involves buying longer term options and selling an equal number of shorter term options on the same underlying stock or index with identical strike prices. Now, this strategy can be executed with calls or puts, and the results are usually the same if we stick to the same strike price and expiration date. Now, unlike the struggle or the strangle, where you need the stock to move or implied volatility to increase in order to make money, calendar spread is exactly the opposite. Calendar spread, basically, if you scroll down to see the chart, yeah, a little bit more. Yeah. So, as you can see, most of the profit on the calendar is made when the stock remains near the strike. So if the stock is trading, for example, at $100, you basically sell put with a near expiration, 100 put, and you buy 100 put with expiration cover out of money. And then you just wait. So this strategy is basically theta positive. So as the time goes by and the stock doesn't move, the calendar starts making money. So by having in your portfolio a mix of strategies like straddles, strangles, and calendars, you basically hedge your bets. So calendar, you want the stock to stay near the strike. If it moves a little bit, it's usually okay. If it moves too much, the calendar might be losing money. But at the same time, if you have in your portfolio also straddles and the market is making a big move and all stocks are moving, and then your calendar is likely to lose money. But at the same time, your straddles and your strangles are likely to make money. So you kind of hedge your bets by holding different strategies in your portfolio, so you're not exposed too much. And this is basically true for any strategy, because when I started trading options, I was trading mostly iron condors. So iron condor basically, as most of you probably know, it's also a market neutral strategy, and you sell a strangle and you buy a strangle which is further out of money. You basically create a tent and you want the stock to stay inside this tent. Now, it's all good as long as the stock stays inside the tent. But if the stock makes a big move, it might be very difficult to adjust, and you might start losing money, and sometimes the losses can be very significant. So this is why I always say that, some traders say, we're going to sell premium. What does it mean, sell premium? Sell premium means that you are using strategies that are theta positive, and you wait. You basically have the time on your side, and you wait and you wait and you wait till the time passes, and if the stock doesn't move, or it moves but moves maybe a little bit, you start making money. But once in a while, the stock market can make a big move. So when the stock market moves big time, especially when it collapses, most of the stocks will go down and pretty significantly. So those iron condors will start losing money very fast. So if you have, and I'm not saying that it's wrong to trade iron condor, But in my opinion, you shouldn't be trading in exclusively strategies like Iron Condor, because then you're basically exposed to a big move. And when the market moves big time, most of the stocks will also move big time, and there is not much you can do about it, especially if your trade is relatively close to expiration. However, if this happens and you have at the same time strategies that are Vega positive and gamma positive, like Straddles and Strangles, you basically have a very good hedge. And this is why Straddles and Strangles can also serve as the black swan protection. If you remember what happened with I believe it was around 2015 maybe, with the flash crash, when market really crashed. This is the situation. If you have a straddle in your portfolio, it can easily make 100%, 200%, even more, because the market really crashed and most of the stocks really crashed, and also implied volatility really jumped over the roof. I think it jumped to something like 80 or even close to 100 from average of 15 to 20. I'm talking about the VIX, which is basically fear index. So if you had only iron condors in your portfolio during the flash crash, it is not unreasonable that your portfolio would be down 80 to 90%. But if you had also straddles and strangles, they would offset the loss very significantly. Now, another thing that is very important is the position sizing. And in SteadyOptions, we basically have model portfolio, and most of our strategies will allocate about 10% of the portfolio to any specific trade, which means that if specific trade has lost, let's say, even 30%, the overall loss of your portfolio would be 3%, because you allocated only 10% to this specific trade. And with more risky trades, like calendar, I consider it a more risky trade, because the stock can move, and if a stock moves and you go outside the tent, the loss can be more significant. So for the calendar, we basically usually allocate only 5%, because it's a more risky trade. But again, the key to success, in my opinion, is not to focus on one strategy, is to have mix of strategies, and the strategies have to balance each other in terms of the Greeks. So if you have some strategies which are gamma positive, maybe have a couple of trades that are gamma negative. So basically you are hedged if there is a big move, and same regarding Vega. Now, it also depends on the overall market environment. For example, if a market environment is relatively calm and the VIX is at lower level, let's say 15, 16, 13, I'm not talking about 10 because we haven't seen 10 for a while, but I would consider the current environment, which is 15, 16, relatively low. So when VIX is relatively low, we would probably put more strategies that are Vega positive, which means they would benefit if the VIX makes a sudden move up. So if VIX suddenly jumps from 15, 16 to, let's say, 25, 30, and you have a couple of strategies like straddles that are Vega positive, they will benefit, and benefit significantly. On the other hand, if VIX is relatively high, let's say 25-30, then we might use more strategies that are Vega negative, like iron condor, because there is a good chance that VIX will come down and overall implied volatility will come down, and trade that is Vega negative will benefit. Because the premium of options, you basically sold options at higher premium, and you are expected to buy them back at lower premium. Now, if you sold them at higher premium, usually it means that the implied volatility was relatively high. And if implied volatility goes down, then it's reasonable to expect the options premium to shrink. And then the options that you sold, you are supposed to buy them back for lower value. So this is basically short and brief descriptions on those two strategies, straddle and calendar. And one more thing worth mentioning is that we don't just automatically enter straddles or calendars on any stock. We do very significant and extensive backtesting to see how those strategies performed in previous cycles. So, for example, I read a lot studies, for example, by many options gurus that they say, okay, we will only sell premium. And if you buy, for example, straddle before earnings, it is not going to work. And they basically did a lot of studies to prove that those straddles are not going to work. But the problem with those studies is that they do it in kind of not very specific matter. They say, okay, the rule is that we will enter a straddle 20 days before earnings announcement on all stocks, and we will exit just before earnings announcement. So they don't take into account that not all stocks are suitable for this specific strategy. And even if a stock is suitable, maybe this cycle, the price of the straddle is too high compared to previous cycles. Maybe it's not suitable to enter 20 days before earnings, but maybe 10 days, maybe 5 days. Exit is also important. The study says, okay, we enter 20 days before earnings, and we exit at the day of earnings, just before the earnings is announced. But they don't take into account everything that happens in between. Maybe you enter 20 days before, but 2 days later, you already reached your profit target. So maybe the stock moved, and the straddle is already sitting at the 10% gain. But then 2 days later, the stock moved back to the strike. So the straddle is back to break even, or maybe even a loss. So the study will say, okay, this specific straddle didn't make money. But in real life, it did, because we already sold it for 10 or 15% gain. So everything that happens in between, all the parameters, like we say, the devil is in details. It's not the strategy itself, it's basically how you implement it, which stocks you use, when you buy, what price you pay. If you overpay, it's not different than with stocks. Maybe you like Apple, but maybe you like Apple at $200, but you don't like it at $300. So you wait till it falls back to $200. Of course, you might wait forever, but that's a different issue. But paying the right price for the right strategy is very important. So maybe we're using same strategies for the same stocks cycle after cycle after cycle, but then after 10 cycles, We suddenly don't use it. Why? Because the price is too high. Because the overall environment is not good. Because the implied volatility of the overall market is way too high. And when the implied volatility is way too high, then most straddles are also too expensive. So we're going to wait. And meanwhile, maybe we implement some strategies which are Vega negative. Vega negative, which will make money if overall implied volatility goes down. Any questions? Okay, calendar. How do you manage the trade, especially the losers? After the first month expires for the calendar, do you close the trade down or do you sell another strike? Okay, so for this specific setup, earnings calendar, the short option is expiring after earnings actually. So both options expire after earnings. It's a very specific, a very unique setup. I don't think, I actually haven't seen anyone using this specific setup. Many people are using setup when short options are expiring before earnings. And this is okay too, but this is a completely different setup. Setup that we're using is both options expiring after earnings. So because we're closing the trade before earnings, so both options are still trading. They're not expiring. Now, how we manage the losers? So two ways. First way is by position sizing. As I mentioned, because we considered calendars a more risky trade, so we allocate only 5% to this position, and usually we stick to 5%. So even if the calendar has lost, let's say, 40%, which is also pretty unusual, but it could happen. But 40%, if you allocate only 5% of your portfolio, then your overall loss of the whole portfolio is only 2%, which to me is acceptable. Now, second way to manage it is if we feel that the calendar is still cheap and the stock is going probably to reverse, then we might add the second half. So if, for example, the stock was trading at $100 and we bought a 100 strike calendar with a half position, and now the stock went down to, let's say, $90. So at this point, the trade might be a loser. Again, depending on implied volatility, depending on many factors. But at this point, we might buy another calendar at strike maybe 80 or 85, depends on market condition. So we basically move the whole tent in the direction of the trade. And this way, if the stock keeps moving in the same direction, then the new calendar, the new half position that we bought will likely make money and at least partially offset the loss of the first position, of the first half. So this is basically the management in shortly, but there are, of course, a lot of nuances, especially the market conditions, how much time till earnings is still remains, how cheap or expensive the calendar became, etc., etc. And we had a few calendars that had decent losers, like 50, 60%. It did happen. It's not very common, but again, even 60% on a half position is only 3%. But on the other hand, we also had many trades that made between 20 and 30%. And this is why I always say with calendar is higher risk, higher reward. If a stock cooperates, then you can make significant gains in the range of 20 to 30%. If it doesn't cooperate, you might lose, but big losers are usually not very common. Does VIX usually spike when prices dive? Yes, absolutely. VIX then tends to calm down as prices recover. This isn't a good setup for a calendar spread, is it? Generally speaking, yes. Generally speaking, if VIX is way too high, that also means that calendar spread is going to be expensive. And when I say expensive, I compare it to same setup in previous cycles. So calendar spread that basically shows trend to increase as we approach earnings, usually it happens. However, when VIX is very high and then it comes down and goes down, then calendars might suffer. Yes, exactly. And this is exactly why I mentioned that when VIX is really high, we tend to do less trades that are Vega positive. And straddles and strangles, also calendars, all three strategies are Vega positive. So they benefit when implied volatility goes up, but they suffer when implied volatility goes down. And this is exactly why we tend not to trade them as much during periods of really high VIX. Now, if VIX is around 20, it's usually still okay. If it goes to 30, 40, 50, then it becomes much more problematic. And not only in terms of implied volatility, but also in terms of stock movements. Because when VIX is really high, that means that the overall market is very volatile. So when you put a calendar, you want the prices to stay relatively not moving that much. And if VIX is really high, then there is a high probability that prices will move, and this is not good for calendars. So basically, if you look at our performance page, and you look at the periods of really high volatility, when VIX was 30, 40, you will see that we traded basically no calendars during this period of time. But we had other strategies that might make money. We had variations of straddle, for example. We had something, this is relatively new strategy that was designed by one of our contributors. It's called the hedge straddle. So hedge straddle is basically when you buy straddle, but at the same time, a straddle or a strangle, but at the same time you sell strikes that are covered out of the money. So in this case, you're basically hedging the straddle, and if implied volatility starts to go down, then the short options start to make money, and they might offset the loss of a long straddle. But this strategy is a little bit more advanced, and again, there are times to use every strategy. Right now, I believe we have around 5 to 7 strategies that we use on regular basis, but we use every strategy based on market conditions. So, for example, in the current market conditions, most of the strategies are straddles, strangles, or calendars. But when VIX is going up significantly, then we might switch to other strategies. More questions?
It's showing in the
Done? I hope I wasn't talking to myself all the time. Done?
I guess one question.
Hello?
Yeah.
You can hear me, right? I wasn't talking to myself all the time. Okay.
Ask is it's very
Where can we
fundamental.
learn about the hedge strategy? So the hedge strategy, basically all the strategies that we are using are described in great details on the forum. Usually you have to be a member to access it because those are relatively advanced strategies. We also have other services that we are offering to members. We currently have 6 different strategies, 6 different services. Some of them are more directional than others. Some of them are non-directional. For example, we currently have a service that trades TLT, which is the ETF related to bonds. And the idea is that bonds are usually linked to oil prices. So this is something that not many people are aware, but this is another strategy that we are using. It's not under SteadyOptions main service, it's a separate service. And basically what you can do if you like the overall concept of what we're doing, you can sign up for 1 month a trial for all 6 services. I think it's currently $100 or $150, I don't remember. And if you like it, then you can continue with whatever service you like or all services. But the main idea is that we put a lot of emphasis on education. So we don't put a trade, send it, and forget it. No, we discussed every trade. Every trade that we put has a separate discussion topic, and every discussion topic has a specific link to a strategy overview. It could be straddle, it could be strangle, it could be a double diagonal in our strategy that we are using. And then members can ask questions, can put maybe a trade which is similar, or some will skip a trade altogether if they feel that it doesn't suit them. But the idea is that our service is mostly educational service. It's not an alert service. Not an alert service in a term that we send opening trade, we send closing trade, and that's it. We do it too. And some members might say, okay, I'm not interested in all the educational stuff. Give me trades, I just follow you, I just copy you, that's it. But in my opinion, this is not exactly the correct way to use the service. The correct way is to learn the strategies, and then you can basically do whatever suits you. You can do something similar. You can do it's more like a trading ideas generator and not trading alert services. This is the main difference. I hope it makes sense. Yeah, so the link to the site is very simple. It's there are 3 links on the site of the meeting that link to Straddles, Strangle, and Calendar. and this is basically our website. So the website has a lot of free material. We have a blog that has right now, I believe, over 500 articles, and all of them are free. And if you want to go a little bit deeper and learn about specific strategies, how we implement them, what we do when we enter, and also track the performance, then you have to sign up to become a member. And again, I think that doing the trial is the best way to start. This way you basically see which of the services suits you. Maybe it's SteadyOptions, maybe it's SteadyOptions. It's the service that I mentioned that trades TLT. So many members subscribe to all services because they want to have a little bit more diversification. And because, again, no strategy will perform equally well all the time. But if you have few months that a specific service maybe doesn't perform as expected as well as previous years, then you have maybe another service that performs well. And I just had an email from someone who is subscribed to two services, SteadyOptions and SteadyOptions, and he said, yes, SteadyOptions performed this year not as good as previous year, but SteadyOptions made 75% this year. So by having both, he basically has a very good diversification. And the nice thing about it is that those strategies are completely non-correlated. So if you trade, for example, TLT, which is related to bonds and related to oil prices, it has zero correlation to overall market move. You don't care what the S&P 500 does. You don't care what NASDAQ does. You can make money as long as the correlation between bonds and oil holds. And if it doesn't hold, then maybe some other strategies will make money. But again, I always say diversification, this is the key.
Well,
And you
really
can look at my
appreciate all the
collection as
time.
well. Sorry, say it again.
Thank you so much for spending so long and longer than was necessary by virtue of our difficulties, which we apologize for. But I think I got just the beginnings understanding of the unique approach and to trading options, anything, and a very thorough one. I'd love to get into it further, but out of fairness to you and everybody, taking everyone's time so long, I think maybe we should just thank you so much once again.
You're very welcome. My pleasure. And any questions, you can always contact me. You can put my email on whenever you have discussions, or we also have a contact us form on our website. If you scroll on the website down to bottom of the page, you have a link to contact us form. So anyone can contact us. Yeah, just at the bottom, at the very bottom. Yeah, exactly. Yeah, I had to put no soliciting, advertising, or marketing because so many emails that trying to sell me something, and even if I put it, still doesn't help. But that's okay.
Well, thank you so much again, and we better let you go because you've been here half the night. So we'll just say thank you one more time.
Okay, you're very welcome.
Thank
My
you.
pleasure.
Okay,
Bye.
thanks. And with that, I think we better let it go because life's for everybody. So we'll just thank everybody for their patience and we hope they got some ideas and some new approaches. Thank you very much, and we'll say good night. Thank you.